Russia's economy since 2022 has been a story of defiance under immense pressure. Few could have predicted the sheer scale of the challenges it would face, or the resilience it would show in response. When the West unleashed sweeping sanctions, many predicted a total collapse, currency in freefall, industries paralyzed, and society in crisis. The world braced for a dramatic unraveling, expecting Russia's financial system to buckle under the weight of isolation. The initial shock was severe. The ruble plummeted overnight, the stock market slammed its doors shut, and Western brands vanished from Russian streets, leaving behind empty storefronts and uncertainty. Yet the predicted economic freefall didn't fully materialize. Life, though altered, continued. Russian cities adapted and people found new ways to cope with shortages and rising prices. Instead, Russia began a painful but determined recovery, forging a new economic reality under isolation. Factories ramped up domestic production, and the government poured resources into rebuilding critical infrastructure. The Kremlin rewrote its playbook, turning away from the West and seeking new partners. Trade routes shifted eastward, and deals with Asian and Middle Eastern countries became lifelines for the economy. The world watched, surprised as Russia's economy stabilized, forcing a rethink of economic warfare's true impact. Analysts debated whether sanctions had backfired or if Russia's adaptation was only temporary. Despite being cut off from global finance and technology, Russia managed to stabilize its currency and redirect energy exports. Oil and gas continued to flow, bringing in much-needed revenue and keeping the economy afloat. As of June 2025, the big question remains: is this recovery sustainable, or just a temporary surge fueled by debt and state intervention? Can Russia maintain this momentum, or will deeper cracks begin to show? To understand Russia's future, we must examine the extraordinary economic battle it has fought over the past 3 years, a battle marked by hardship, adaptation, and a relentless drive to survive against the odds. In early 2022, the world watched as the West unleashed an unprecedented economic shock on Russia, a move that would send ripples through global markets and everyday Russian life. This shock was carefully designed to cripple Russia's economy, aiming to isolate the country financially and technologically from the rest of the world. The most powerful blow came with the freezing of $300 billion of Russia's foreign reserves, an act that instantly cut off a vital financial lifeline and left the country scrambling for alternatives. The ruble plummeted in value, inflation soared to levels not seen in decades, and the central bank was forced to hike interest rates to a staggering 20% in a desperate attempt to stem the panic and stabilize the economy. Western brands like McDonald's and Apple pulled out almost overnight, their departures becoming powerful symbols of Russia's sudden and profound isolation from the global marketplace. Sanctions struck at the heart of Russia's industrial core, banning imports of critical technology, machinery, and components essential for modern manufacturing. Factories across the country, especially in the automotive sector, ground to a halt as supply chains snapped and production lines stood idle, unable to source key parts. The West's goal was clear: degrade Russia's manufacturing and military capabilities, betting that the country could not survive without Western technology and expertise. The impact was immediate and severe. GDP shrank sharply, thousands of businesses shuttered, and the banking sector teetered on the edge of collapse. Many in the West were convinced that Russia's economy would soon break under this immense pressure, expecting a rapid unraveling. But inside the Kremlin, surrender was not an option. Russian leaders quickly convened, determined to chart a new course. Instead of capitulating, the government began to fight back, deploying its own set of economic tools and strategies to weather the crisis. As the world watched with bated breath, the question remained: could Russia withstand the storm, or would it be swept away by the tide of sanctions and isolation? Instead of panicking, the Kremlin activated its Fortress Russia strategy. Strict capital controls forced exporters to convert foreign earnings into rubles, stabilizing the currency. Demanding gas payments in rubles from unfriendly countries further propped up the ruble. These measures worked. The ruble rebounded, defying expectations. The government unleashed massive fiscal stimulus, supporting industries, banks, and social programs. State spending became the main engine of growth, cushioning the blow of sanctions. Russia pivoted eastward, finding new markets in China, India, and Turkey for its discounted oil and gas. This trade shift kept revenue flowing and funded the war effort. By 2023, the economy returned to growth, outpacing G7 countries in 2024. International forecasts were repeatedly revised upward as Russia defied predictions of collapse. The Fortress Russia approach, currency controls, state spending, and trade pivot transformed the economy. Russia's economy was battered, but it refused to break. The world had underestimated its resilience. The war itself became a powerful economic engine. Military spending surged, reviving factories and creating jobs across defense industries. Unemployment dropped to record lows, masking deeper economic pain. The state promoted the war as both patriotic and prosperous, maintaining public support. To bypass sanctions, Russia built a shadow fleet of tankers to export oil, and used parallel imports to access Western goods via third countries. These workarounds kept vital exports and technology flowing, despite higher costs and logistical hurdles. The war economy created short-term stability, but at the cost of deeper structural imbalances. Russia's ability to adapt under pressure was impressive, but not without consequences. The question, how long can this war-driven growth last? Russia's most profound shift in recent years has been its dramatic pivot to the east, a move that is reshaping its economy and global alliances. With Europe now largely closed off as a trading partner due to sanctions and political tensions, China has stepped in to become Russia's economic lifeline. Today, China is not only Russia's top buyer of oil and gas, but also its main supplier of essential goods, electronics, and advanced technology. India too has emerged as a significant customer for Russian energy, eagerly snapping up discounted crude oil that once flowed to Europe. This has helped Russia maintain export revenues despite Western restrictions. These new trade routes, stretching across Asia and beyond, have offset much of the loss from Europe, demonstrating how global markets can adapt and reconfigure with surprising speed. However, this growing dependence on China brings new risks. Beijing now holds immense leverage over Russia's economy, influencing everything from energy prices to technology access. The yuan has increasingly replaced the dollar in Moscow's markets, and Chinese brands now dominate Russian store shelves, signaling a major shift in consumer habits and financial systems. Yet shipping oil to Asia is far more expensive and logistically complex than piping it to nearby Europe, which squeezes Russian profits and adds new operational challenges. While China supplies a vast array of goods, it cannot fully replace the sophisticated Western high-tech imports that Russia once relied on for its industries and innovation. In effect, Russia has swapped one dependency for another, potentially even deeper and more difficult to escape in the long run. The technology gap remains a major vulnerability for Russia's future growth, limiting its ability to modernize and compete globally. The pivot eastward is both a vital economic lifeline and a long-term strategic risk, shaping Russia's destiny for years to come. Beneath Russia's apparent stability, serious cracks are widening. Persistent inflation, fueled by government spending and import costs, erodes living standards. High interest rates make borrowing expensive, stifling private investment and consumer spending. Labor shortages are acute. Mobilization and emigration have drained the workforce, especially skilled professionals. This brain drain, combined with demographic decline, limits growth and innovation. The state budget is under strain, oil revenues are volatile, discounts to Asian buyers cut profits, and military spending now dominates. Every ruble spent on war is one not spent on infrastructure, health, or education. The war economy is dangerously concentrated. Growth is driven by defense, not diversification. Factories geared for war can't easily switch to civilian production. Russia's current model is resilient in crisis, but brittle and unsustainable for the long term. The war is both the engine and the Achilles heel of Russia's economy. Experts are divided on Russia's economic future. Some argue a slow-motion crisis is inevitable. Sanctions, brain drain, and tech gaps will erode competitiveness and trigger a reckoning. They warn Russia is burning its future to pay for its present, risking a severe budget or currency crisis. Others see resilience, low external debt, vast resources, and a government skilled at crisis management. They predict not collapse but stagnation, a managed decline with Russia resembling a late-stage Soviet Union or modern Iran. The likely outcome, a stable but backward state-dominated economy, falling further behind the developed world. For the Kremlin, this may be an acceptable trade-off for geopolitical goals. The debate continues with no clear answer in sight. Major forecasts for Russia paint a mixed picture. The IMF and World Bank now expect modest growth, driven by state stimulus and redirected trade. But they warn this growth is unbalanced. Military and state sectors thrive, while private enterprise stagnates. Oil prices remain the key risk. A sharp drop or tougher enforcement of price caps could trigger a fiscal crisis. Russia's dependence on China is another vulnerability. If Beijing pulls back, Russia could face true isolation. Analysts watch China's signals as closely as Moscow's data, knowing Beijing's choices may decide Russia's fate. The consensus: no sudden collapse, but a gradual erosion of economic potential. Russia is likely to miss out on global trends like green energy and AI, falling further behind. The story is one of slow decline, not dramatic disaster. The future remains uncertain, balanced on a geopolitical and economic tightrope. Russia's 2025 economy is a paradox of resilience and risk. The Kremlin has stabilized the economy through state control, spending, and a pivot eastward, defying predictions of collapse. But this resilience comes at a cost: high inflation, labor shortages, technological lag, and deep dependence on China. The war economy is built for survival, not long-term prosperity, and is vulnerable to shocks like falling oil prices or shifting alliances. The most likely scenario is a managed decline, no collapse but steady loss of economic and technological ground. Russia's future depends on global markets, the war's course, and political choices in Moscow and Beijing. The world watches, knowing the outcome will shape the global order. The fate of Russia's economic gamble remains unwritten.